buckle. But as the Iran war headlines continue to shake the markets, how should you ride the volatility? Because there's a lot. Joining me now, Empower Chief Investment Strategist Marta Norton. Marta, sure, we could look at the VIX. The VIX earlier skyrocketed above 30. Again, it's behaving like the markets here because it is coming down off those earlier highs, just as the market is coming up off the earlier lows. Right now, we've got it at 27.2. But, still coming down. I think that's pretty impressive. What's going on in the psychology of the markets, and what cues should investors take from that?
Well, it does feel like it's all about psychology right now. It seems as though almost every morning we have a similar narrative where the market really collapses and then we have a recovery of sorts. So you referenced the dip buyers. We also have some announcements from G7 saying that they stand at the ready to release reserves. Potentially that gave people some confidence to go back into the markets. I think what investors are wrestling with is the idea that typically geopolitical events are something that we should look through. They don't change the underlying cash flows of stocks and bonds. And yet in this instance, the disruption to the energy markets is so meaningful that there does seem to be, at least even at this early stage, some measure of economic impact.
It is really hard, though, for investors to sort of dodge the headlines, bob and weave, especially considering when you see that if you are of that group that wants to buy on the dips, if you just look at the 5-day point moves on the Dow last week alone, I mean, Monday down 73, then Tuesday, a bigger washout, a loss of 403. So people may have thought, OK, that's a good dip. It was, because then Wednesday, the stock market popped 238 for the Dow. Thursday, well, all of that gone, down 784. Friday, down 453. And here we are today, struggling once again with the Dow down about 320. So what is your advice to people watching saying, boy, it's like a pinball moving around?
Well, I think the first thing to do is to recognize our own limitations. We don't fully understand how this conflict is going to play out. We don't know if it's going to end today. We don't know if it's going to end in 4 months. And so one of the guideposts that I return to is not necessarily price movement, but where are valuations actually headed? And we came into this conflict both for U.S. stocks and for non-U.S. stocks, and our estimation at overvalued levels. There are these pockets of opportunity that I get excited about in software or among members of the Mag 7. But broadly speaking, the market has been overvalued. And I think if you're really going to be a productive buy the dip investor, you want to look for where those valuations actually become approachable. You are seeing a little bit of movement, even areas like financial stocks, because they're getting hit by so many things. Those things are coming down. That's where I would start to look, where the valuations are the signal and not just the price movement.
Yeah, you still like 5 of the Mag 7 there, NVIDIA, Alphabet, Amazon, Microsoft, and Meta. But I've got to ask, if people are wondering, do I ladder in? Do I buy chunks each day that I start to see a dip? For example, the airlines. The airlines have gotten really slammed since the Iran war began, and it's understandable, but it's also the fact that you got to take into account the piece that involves jet fuel. Jet fuel prices are skyrocketing because of the situation.
Right. Yeah, there's a fundamental element there, right? Because that's a cost of the business. I think what we can look at when we're looking at this Middle East conflict is almost a scenario analysis perspective. We can look at a base case where this does wrap up relatively quickly, and we can look at maybe the less likely but still possible worst case scenario where this is with us for quite some time and we potentially have much higher oil prices than we expect. So I think that guidance of kind of phasing in, dollar cost averaging, I think that's an appropriate stance if you're trying to kind of spread out your bets across